Oil and Gas Investment Board for the City of Manistee. Today's meeting date is May 2nd, 2022. Kelly, could you please take the roll call?
I don't typically for this, Mayor.
It says roll call on it, but okay.
If you just want to call the meeting to order, it should be good. Yeah.
Okay. I'm calling the meeting to order then. Old business, Hound Resources royalties, 2021, $664. Hound Resources has notified the city that there will be another payment made before the end of April 2022, bringing royalties current through 2021. Ed, would you maybe say a few words about that?
Sure. So they were still trying to clean up their acquisition of Aztec Producing. We did get one small check. I did talk with our contact there, and she said that they were going to be getting the checks out. That was a couple weeks ago. I still haven't seen them, so I'm going to give it another week, and then I'll follow back up with her. I think they're probably still just trying to finalize stuff, but at least the communication is open with them, so that's where we're at.
Any questions? New business, approval of minutes from February 1st, 2022.
So moved.
Second?
Support.
Okay. And now we're on to investment advisor update and commentary.
All in favor?
Oh, let's take roll call. All in favor, say aye.
Aye.
All opposed? Motion passed.
Okay, Woody, I think you're up.
Great. Good morning, everybody. I believe everybody has the booklet in front of them. And so I'll start with the Bartlett's Market Assessment page, page 4. And I think to summarize, the two primary points facing the markets today would be inflation, the trend of inflation and the expectation for inflation going forward. And then obviously the challenges facing Ukraine with the war and kind of the knock-on effects of supply disruptions and primarily because of energy, because of Russia, and other issues that might evolve from that conflict, which we don't know about, but it does create uncertainty. I think the big issue is inflation and how persistent it is and how aggressive it might be. And those are the biggest issues. But generally, we still have fairly low interest rates from the perspective of several decades. We have inflation expectations as calculated by the markets, and I'll show you a chart in a moment that shows that inflation expectations are still fairly low once you go out past the next year or 18 months. And so low inflation, somewhat low interest rates, and an economy that's pretty good with fairly full employment are very positives for the market. So even though there's a possibility of a recession, I think it's calculated somewhere between maybe 25% and 33% developing in the next year. Generally, the economy looks pretty good. So still a lot of turbulence because of these overhangs of inflation and the conflict in Eastern Europe. So if we go on to the next page, it shows that these geopolitical events are typically somewhat short-lived as it relates to the markets. You can see some of these other events going back to Pearl Harbor, where in the short term, the market is very emotional and around what might happen. It's sort of like focus on possibilities and not probabilities. And then over the long term, over a longer period of time, investors become more rational and more focused on probabilities instead of possibilities. And it's surprising when you look at some of these events, such as particularly, let's say, the World Trade Center bombing, or even 9/11 based on a 6-month basis, or Pearl Harbor, that on average, markets don't do that badly in the face of some of these very severe crises that we've had. At the bottom of the page, you can see on average over the 6-month period, the market's up 7%. On a 12-month basis, it's up 12%. So that's not to say there hasn't been a couple bad periods, particularly the Arab oil embargo, which some could say this is maybe a little bit of a version of that. But back in 1973, the U.S. was much more dependent on imports of oil, and today very much less dependent because of our own drilling and exploring, things like Alaska, fracking, all these kind of things have made us much less dependent on oil. The next page is the inflation expectations, and I alluded to this a moment ago, which is I think everybody, all Americans, all consumers are concerned about inflation because it erodes our pocketbooks and eventually causes interest rates to go up, which will then erode our portfolios. And you can see on this chart that there are securities out there, they're called Treasury Inflation Protection Securities. And they're issued by the US government, and there's billions and billions of these outstanding. And it's a way for the big smart money to place their bets around what they think inflation will be. And so by kind of analyzing these securities, you can tease apart what the inflation is expected to be by global investors around the world. And you can see that over the next 10 years, it's still, if you look on the far right-hand of that dark line, the far right-hand side, it's showing that over the next 10 years, inflation is still only expected to be about 2.8% a year, in spite of it being currently 8.5%. So the 8.5% is the current inflation. The 2.83 is the expected inflation that investors are planning on. Any questions so far? There's a lot of technical stuff here particularly with this chart.
So Woody, are you telling me that the tips investors, knowing that the Fed's going to raise probably 2 points by the end of the year, if not more, are not factoring that in? I mean, at some point, the Fed's actions will influence those rates, right? And they're supposed to raise by 50 basis points a couple times, as I understand it.
Well, there's a distinction here, Ed, that this is not the interest rate, this is the inflation rate.
Okay.
So the interest rate could be, recently we've had negative bond, basically negative real yields, which means if you take the yield on the bonds and subtract inflation, you're getting a negative return. But we don't know a year from now whether that could change, and the interest rate on a 10-year bond could go from about 2.8, it's currently 2.8%. It could be 4.8. It could be 5.8. It could be 3.8. But right now, the relationship between bond yields and inflation is out of whack historically. But this chart is not referencing what the interest rate's going to be. It's just showing what inflation is likely to be. So I think to answer your question, interest rates will be going higher unless the economy slows down significantly or goes into a recession. Pardon me. In that case, interest rates could decline and go back to where they were, in recent months or a year ago. But right now, it would appear that if the economy stays fairly strong, that interest rates will continue to increase. Does that help?
Yep.
So, pardon me.
I just need
I'm
clarification.
not going to dwell on the rest of these.
The mayor, Woody, the mayor has a question. Go ahead, Mayor.
Sorry. So, looking at interest rates,
I'm having difficulty hearing.
I'll repeat the question. Go ahead.
looking at the interest rates, are the interest rates, even though we expect them to go up, are they still going to be considered moderately low?
The mayor's question was, even though the Fed's expected to raise short-term interest rates quite a bit in the next 12 months, from a macro perspective, are they still considered to be, moderately low or, kind of in a more of a normal range than what they have been?
I would say no, that that interest rates typically are above the inflation rate. And even taking into account that inflation, that an 8.5% number is not likely to last, but even if it, let's say, goes back down to 2.5, you would normally expect interest rates to be somewhere, ahead, above that, 3, 3.5, 4, 4.5. So, there's still a gap between between current interest rates and inflation based on what it would have been historically. Does that
I just
help,
remember
Mayor?
I just remember the 80s, unfortunately, with 18% interest rates.
She's saying she recalls the 80s when we had 18% interest rates, but I think your point, Woody, correct me, is that inflation wasn't running at 18%, but maybe at 10% or something, so there was a gap. Is that what you're trying to point out?
Yeah. Well, I'm glad she mentioned that, because in the 80s or the late 70s, inflation became embedded in the economy, and it became embedded in consumers' minds. Everybody wanted to buy real estate because that was the best way that you could hedge against inflation, and you could buy real estate, put a little bit down, and that's the way you could protect yourself from inflation, because everybody had the expectation was inflation was going to last at the high single-digit level for a long time. And so the Federal Reserve had to break that mentality. They had to break that expectation, and they had to do it by raising interest rates to very high levels and shutting the economy down. And it was bitter medicine, but it was really the only medicine that you could really, I think, Volcker, the chairman of the Federal Reserve at the time, knew that bitter medicine was required to sort of fix the system. And it did fix the system, but at the expense of a nasty recession in 1980 or 81, lasting well into 82. The stock market started to pick up in August of 82, but that was about 4 to 6 months in advance of the economy recovering. Today it's a little bit different. Today, inflation expectations are still fairly low. However, this is the first time since 1980 that the Federal Reserve was not preemptive. Ever since 1980, when you start having the Federal Reserve Board thinking that there's going to be inflation because money supply has been increased, all the things that we've been doing now for 10 years, the Federal Reserve in the past would have started tapping the brakes, raising interest rates a little bit. But for various reasons I won't go into, many of which are political, they have not been tapping the brakes. They're a little bit late to fixing the problem. They flooded the system with a lot of money and a lot of stimulus. There's a lot of savings, households, corporations. There's trillions of dollars sitting out there in savings accounts, et cetera. And people, they've just overstimulated, and they're a little late to slowing things down. And that's the first time since 1980. So they're sort of in a little bit of the same position they were in 1980, which they're kind of, instead of anticipating the problem and starting to do preventative actions. Now they're having to do it sort of after the fact, and that's a little bit harder to do. That's a little bit more than Madam Mayor you were looking for, but maybe,
it is
do you all
helpful.
understand that, or is there any other further questions on that?
Oh, I just don't want to go through that again.
She just said she doesn't want to go through that again.
It was harmful.
Well, yeah, it was very
Many
painful, and I think that is making the market a little skittish, because some people feel like it's going to be hard to get this inflation problem under control. The big smart money seems to think that inflation will last for about 18 months and then it will slow down. But every month or two that it stays at this high level is another month or two of concern that the longer term this inflation is going to be a stickier problem. And I think the Federal Reserve is all hands on deck right now trying to make sure that they kind of try and nip this in the bud, because once it gets out of control and it gets built into people's minds, then the behavior sort of it's self-fulfilling after a while. The biggest problem with inflation is basically wages, because once you start having wages reflect inflation and they go up 4 or 5%, then prices have to go up, and then it starts to continue. And it's most prices are resilient. They're flexible. Wages are not. Once people get a wage increase, they don't get a decrease because you have no inflation or deflation. And so the wage portion of it can be a bigger part of the problem.
Okay. Thank you.
I don't know if I'll dwell on these other pages unless anyone in the group has a question about it. Some of these we've talked about at previous meetings. I don't know if we talked about page 7, which is the one after the inflation expectations, but this goes to show that just because the Federal Reserve is raising interest rates, it's not always bad for the economy or the stock market, because the reason they are raising interest rates is because the economy is doing well, corporations are making more money, and they're just trying to slow things down a little bit before inflation becomes a problem, which is always the ultimate problem of an economic expansion. Eventually you have inflation. So you can see that over time, during these tightening periods, where tightening refers to interest rates, the Federal Reserve raising interest rates, that's a tightening cycle. During those periods, that if you look on the bottom right-hand corner there, that the stock market, the S&P 500 has gone up on average, about 8% a year during those tightening cycles. Let's see. I won't touch on any of these further pages, and I would go to page 13 under the investment review. And you can see this is as of March 31. A little stale, obviously, because April was a very bumpy month for the markets. And you can see our allocations here, the fund value of about $13.2 million. That's now down to about 12.5, I believe, based on some data I was looking at this morning. I think this data is reliable that I was looking at, so it's a decline of about 6% in April. But we're pretty close to spot on with most of the allocations. The equities were just a tad above 66 versus 65. The next page is the bond portfolio, and you can see the primary factors in looking at a bond portfolio is when the bonds mature, how are they allocated between U.S. Treasury obligations, corporate, and typically mortgage bonds. Those are, and then there's also federal U.S. agency bonds, which would be things like Federal Farm Credit, Home Loan Bank, that kind of thing. So the three categories again are when they mature, how they're distributed by different sectors, and then the quality of the bonds, which is their credit rating. Typically, from AAA down to BBB, those are investment grade bonds. You can see in the little box up on the right that you have a fairly high grade portfolio, and the duration is pretty close to the index. We track the index pretty closely, the government credit index. And the idea is to be diversified with reliable income. And over time, I think as interest rates go up, it hurts in the short term as the bonds get hit by increasing rates. But over a span of a couple years, as the bonds mature and you reinvest them in these higher yields, then it will add to the return of the portfolio. But in the short term, it can have a negative effect on the returns. Any questions on the fixed income, on the bond portion of the portfolio?
So Woody, as rates are rising and the value of the bonds on paper is going down, are you guys less likely to liquidate those and more likely to hold them to maturity, depending on circumstances? I mean, I don't think you're doing a lot of active bond trading anyway, but...
Not necessarily. I wouldn't say that. I would say it's mostly the trading is done around where we can upgrade the return or the risk. Pardon me. We can upgrade the return or the risk of the. In other words, a bond may go down in value, but may go down in value less than other comparable bonds, and so it becomes maybe rich or high priced because it hasn't declined in value. Excuse me. And so today, you'll see bonds being traded because we see better opportunities in another bond, but it doesn't necessarily have to do with the current level of interest rates going up or down.
It's more the relative attractiveness.
Exactly, the relative value of that bond relative to other bonds. That would be the main reason. Of course, their bonds are always maturing in the portfolio, and when they mature, then that's opportunity to reinvest in new bonds. But the trading of the bonds have to do with the relative value of that bond versus comparable bonds. So the next page is how the stock portion of the portfolio, the equity sector allocation, shows you how we are diversified among the 11 Standard & Poor's industry categories. And those are listed along the left side of the page. And you can see the first column is how the Manistee oil and gas portfolio stocks are invested among those sectors. And the second column is the makeup of the Standard & Poor's 500. And then the third column is the difference. And you can see we're generally fairly diversified, somewhat in line with the S&P 500. A couple differences. Right now, we're a little bit more defensively positioned. And for example, healthcare is a classic defensive category. It's not as sensitive to the economy. And so when you get into a difficult market, they tend to hold up a little bit better than most. And that explains why we have about 4% more in healthcare in your portfolio than it would be, let's say, with an S&P index fund. And then on the other side of that, financial stocks tend to be much more volatile and more sensitive to the economy. They do not react well to difficulties in the economy, or a declining like going into a recession or a slowing of the economy. And that's why we're a little bit underweight the financial stocks by 2.3% as of the end of March. Any questions so far? The next page it shows you some of the cash flow additions and distributions from the oil and gas fund going back to 2008. A lot of interesting data here. You can see the fund value as of June 30th, 2008, about 6.7 million. I wish we could get those royalties back to where they were, Ed. Maybe you can talk to those drillers and get them working again. Had some good oil and gas royalties. And then we can see the spend rate, which we've moderated as we've seen inflation come down and bond returns particularly come down, that we've kind of normalized that more around what endowments and foundations are doing more typically. And then the distributions for the capital budget. In spite of that spending rate decline, the portfolio has benefited from the capital market returns that have been very good. And so the distributions have gone up, and you can see that total. And then you can see there have been 3 episodes where the board has decided, in conjunction with city council, to make an excess distribution. And those distributions there are shown that 408,000. So we now have total distributions about $5.7 million, which, before long we'll have more in distributions than what the fund started with. Which I'm proud of, and we should all be happy about as stewards of the fund for Manistee. Any questions on that page? There's a lot there. We did play around with some numbers. I don't have them handy. I think I shared these with Ed, but it showed the value of the excess distributions. If we had kept those in the portfolio, what the value of that money would be today. And Ed, I don't know if you recall what that number was or whether that's worth bringing up at this point, but I think it was something over $600,000.
I think that's right. I did include an exhibit on that in the budget, so council has seen that.
Okay, good.
So,
the next page is the performance, and this, we've had a lot of good years, and this may not be one of those. You can see the 1 year and the 3 year, the 5 year, and since inception. We've the 1 year, the quarter to date, we're doing reasonably. We're doing reasonably well against the Manistee blended benchmark. We have a little over 3 years on that. And that we're actually getting close to 5 years on that, but we're a little bit ahead of the benchmark. Anyway, happy with the numbers. That I think 9% since the inception. This report we're still working on. We have a new reporting system. We switched the reporting system to a new one, and there's still little bugs in it, but these numbers are correct here. Any questions on the performance?
So where's the market gonna be at the end of the calendar year? Mr. Crystal Ball?
I don't have a good crystal ball, Ed. I think it's been a long time since we've had a declining market. We had a very brief market at the beginning of COVID. It lasted really just for a few weeks. We had that, 30% type decline, but it was very, very brief. And it was sort of an external factor. It wasn't not a normal economic factor. So I think I just don't really have a good feel for it. I think it could be, I don't think it's going to be a great year. I think it's going to be kind of a flattish. If I had to guess, I'd say the market's already down significantly. I wouldn't guess it was going to improve a lot. I think we're for kind of a flat to down type of period that could last until there's more clarification on what's happening in Ukraine. The Ukraine thing could turn into a big positive. If that thing gets resolved and Russia is kept in check and has a defeat of sorts, and it warns China off of thinking about doing anything like that with Taiwan, and then you've got Europe and NATO more unified with the U.S. You've got all these allies unified. There's a big rebuilding effort, and Russia is no longer the threat it's been around, that it's been for really decades. That could be perceived as a big positive. I think that's the one kind of wild card out there that people might underestimate, that if this got resolved in the coming weeks or months, that it could be a big positive for those reasons. We haven't really had the allies unified and NATO, defending themselves and having their own defense budgets that are appropriately, calibrated for a long, long time. And to the extent that they do that and we don't have to spend as much in Europe, that could be a good thing.
Any questions?
What are the thoughts in Manistee?
Well, I'd take flat given where we're sitting today. And that's why the smoothing is helpful, right? And, and all the policies up to this point. Because we've been talking for a long time about at some point we're going to have a down market, right? And we really haven't had that since 2008. We had a flat one maybe one year, but so that's where the smoothing really helps out, and then sets the table for moving forward. So.
Yeah, we have, if you go back to your point, and you look at those values, let's say in 2020, you could probably have a somewhat, continued decline in the portfolio value, and the distribution might still be fairly, close to what it was. So, but I think the system, we haven't really spent much time talking about this, but I think your system has worked beautifully in terms of, exposing yourself to stocks and having a healthy allocation to stocks and taking the long-term view, having a spending rate that's smoothed out over 3 years. This would be kind of a classic sort of exhibit A in a textbook about how these kind of things, when they work well and why they work. I think the Manistee example would be, like I said, a textbook example of it working really well, and the board, the oil and gas board, kind of staying disciplined, sticking to it, and really creating a really golden goose for the city of Manistee.
Does anybody have any questions for Woody?
Hi, Woody. This is Jeff. I do have a quick question on the cash allocation. Given the rising interest rate environment, I see that we have some in the USD. I'm assuming that's a cash fund versus the government money investor fund. Is there a better place for the money to be in that rising interest rate environment? Meaning between the two, because I see that they're skewed one more towards the cash fund.
Did you catch that, Woody? The question was about the cash investments between the USD and the Schwab, and where's the best place to be deploying the cash?
Well, I think what is the status of the next distribution, Ed?
We won't get that. The budget's hopefully going to be adopted tomorrow, and then we probably won't take that until early summer, like after July 1.
Okay. Well, we have that that we have to contend with, which is really about 2 months off. So that'll be a big number, and that'll take up probably more than half of the cash. Troy is. I'll check with the fixed income team about the cash, and I think they've recently bought some bonds. I believe there were a few bonds that were just purchased, and it may be that cash number. See if I can get to another screen here. Yeah, there was a lot of that cash has been used up. There was an Amazon bond, Coca-Cola bond, some treasury notes that were purchased, and that cash is down to a lower level now.
Okay, just curious.
Let's see. Yeah.
I'm assuming the difference is nominal at this point, but I'm assuming the money market pays more than the cash account.
Yeah, the question was the money market at Schwab pays obviously a little bit more than the other. I mean, was that kind of just a transitory thing? A bond was sold maybe or matured and then they just hadn't reinvested it? Or?
You mean the high cash level?
Yeah, just as of that measurement date, as of 3/31.
I think that was a high level at the time. I don't recall having the cash that high before, and it's been brought down. And it was just, I think it's a good question, by the way, because the cash yields are very low at Schwab. So I think you don't want to hold money in cash. So I think the point of the question is a good one, is to try and minimize that number at Schwab. And I think that at this point, I think most of the cash that's in there is related to the distribution that we expect in July.
Ed, can you add, because I'm guessing that money market fund doesn't really have any substantial restrictions on additions or subtractions to it.
No, I go in and out pretty much daily liquidity.
Okay.
You have any other questions for Woody? Going? Gone. I think all the questions have been exhausted.
Well, thank you, everybody. Greatly appreciate the continue to be of service. And I believe I'm going to see everybody in August. I believe Kelly was working. I think we did come up with an August meeting date.
It's on the agenda.
And so I'll look forward to that. And if anybody has any questions in the meantime, either feed them through Ed or call me directly.
All right. Thanks, Woody. Have a great rest of your day.
Thanks, everybody.
Bye-bye.
Bye.
Motion to approve the meeting change date.
I'll make a motion.
Support.
All in favor?
Aye.
All opposed? Motion carries. So the next meeting will be August 2nd, or, I'm sorry, August 12th.
Anybody have anything else they want to talk about? Under other? Hearing none, I'll take a motion to adjourn.
Motion.
Okay.
Okay, perfect.